Alright guys, welcome to the next video. In this video we'll talk about what liquidity is, such as buy side liquidity and sell side liquidity. And we'll also be going over what is a liquidity sweep. Alright, so let's get into it. Now, what is liquidity, right? So if I were to draw it out, right, let's say we're in an uptrend, right? Then we're in a downtrend, right? Liquidity is where banks or smart money concepts sell off or buy off of, because that's where most orders are placed, because they're at the lowest or the highest points, right? These are where price came down and orders were either filled or stopped out, and then made a big movement up, right? So for example here, we have two types of liquidities. We have sell side liquidity, which is where buyers are willing to buy here and have their selling stop loss here, right? And then we would have buy side liquidity, which is right here, which is where sellers tend to sell off here, like banks or smart money concepts and ICT, and they put their sell stops here, right? So these are what we call liquidities, because these are where money lies underneath, right? This is where people put their money in the market. Now there's two types. We have external liquidity and internal liquidity, right? So external liquidities are from the swing highs and the swing lows, right? Because these are the main points, right? Because if we were to draw this out on a bigger time frame, it would look something like this, right? So the tops and the bottoms would be right here, right? So this is where your external liquidity would rest. So right here at this low, you would have what's called SSL or sell side liquidity, and we would have BSL appear as buy side liquidity, right? Now I said there are two types, right? So besides external, we have internal, right? Internal liquidity would be such as all these lows, right? Because they're inside of this range, right? So these would be your internal sell side liquidity right here, right? Here's your sell side internal. It'd be at every single low. And then here would be your buy side liquidity, right? And if we were to draw it long, although this isn't as accurate, this is just a drawing, each time we were to come down, touch sell side liquidity, we get a little run down, just a little bit, but then we come up, right? It comes down, touches sell side liquidity, runs a little past it, and then comes up. And then in the end, we have what's called a sweep, right? A sweep is basically when price comes down to either buy side liquidity or sell side liquidity, and it goes right below it to stop people out, right? Because this is where the buyers would have their sell stops here, right? Buy stops here, right? So if price were to come down, stop them out, which is called what we call a sweep, then price would head higher, right? Although this is not always the case, because let's say that we are in a much bigger trend, right? Let's say like price is like this, right? This, although price did sweep here and head higher, it could also come down lower until the external sell side, right? But for now, let's just look at this. So right here is our range, right? So this would be an example of what's called a sell side liquidity sweep, because it reached in sell side, right? Let's say we have a buy side liquidity sweep. That means that price would come up, right? Could go like this, anything, but then reaches this buy side and comes a little above it, right? Comes a little above it, right? And then head lower, right? Because we had this little sweep here. This means that orders that were placed here, ready to be filled or already filled, have their sell stops here. This liquidity takes them out to create money in the market before heading in the correct direction, right? So why is this important? Because markets move to fill imbalances, like I explained, like fair value gaps, and it seeks liquidity, right? Because they want to make money in the markets. So let's take an example and a look at liquidity on charts. So get rid of all of these. So if we were to take a look at this range right here, right? This range, we can see that we have sell side liquidity here, right? Sell side liquidity, and we have buy side liquidity. This would be the range that we would be looking at, right? This is the range we would look at if we were dragging it all the way along to see when it touches, right? So if you see, these would be your external sell side liquidity, right? Because these are the ranges. This is the lowest point, and this is the highest point that we're looking at. But then, as you can clearly see, in these, we have like these lows, right? So let's say like price is up here, comes down, up to this point, comes down, right? And then so on. Our external liquidity would be all of these, right? All of these little lows that is created. These would be your sell side liquidity, right? So as the market plays out, we get our internal and our external liquidity, right? So why is it important? Because as you can see, if we were to scroll out, price seeks sell side liquidity, right? Right? It comes a little lower, right? To stop all these people out. But then what happens after? It comes to seek buy side liquidity, which is what we call a drawn liquidity, which you will learn in the next following videos. So we wait, and we see that this external liquidity gets hit right here, right? We see price comes up, taps this little line that we drew up a little higher to stop people out, right? Stop them out, and then price immediately drops, right? So these would be our external liquidity examples, right? Now let's take a look at what's an internal liquidity, right? So if we were to take a look at this chart right here, right? If we were to zoom in this box right here, right? We would see we have our sell buy side liquidity here and sell side liquidity here. If we were to take a look at this range, like if we were just to trade in this model, this would be our external, this would be our external, right? And these could possibly be our internal, right? This would be all of our internals, right? Well, let's just take a look at external, right? So we have our internal, externals, right? So let's see. If we were to see that price came up here and dropped and created this range, right? Right here, this would be our externals. And we see that as soon as price came up, right? This was a fair value gap that we learned in the previous video. And it came back down to sweep the sell side liquidity, right? See how this wick came by, right? As long as the candle either passes it with a close or a wick, it's considered a sell side liquidity, right? So price came down, sweeps sell side liquidity to take out all these buyers that were all in here, and then it reaches for buy side liquidity, right? And now most people would be like, oh, look at this huge momentum, right? With the close above, they would be like, oh, it's time to buy, right? It's time to buy. They get stopped out, right? But then what happens if we're SMC, ICC? We're like, oh, it's at this range, so let's sell right here, right? We want to sell, but then you guys get stopped out right here. You might ask why? Because liquidity sweeps are used to take traders out, fake them out, right? Even though you may have the right direction of the market, it will still take you out, which is why you need to wait for confirmation and enter off of, let's say, a fair value gap right here, right? So RSI comes down, takes traders out, and then it heads lower, right? Now you may ask, okay, why is it heading lower? Because we had just swept buy side liquidity and reacted off a higher time frame fair value gap, right? Let's take another look at an example of, let's say, a liquidity sweep, right? So if we were to take a look at, let's take a look. right here, right? We have this high and these highs here. And if we're looking to trade inside of this range, you can see that we have buy side here and we have sell side here, right? So let's take a look. See, all of these are what we call internal liquidities, right? Because they're inside of a bigger range, right? This would be our internals, these would be our internals, these would be internal, 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 right? And then these would be our buy side internals, right? See how normally these internal liquidities normally get ran through, right? Because the target is always the highest or the lowest of the range, right? The externals, right? We do get little movements here, right? Low movements, right? Because, we have our internal, which could be external on a lower uh, model or time frame. But the draw is the externals. So if we look, we can see that price came here, swept buy side, right? It came up a little bit, and then it came back down. But then it came up to sweep buy side again. This is what we call a stop hunt or manipulation move, right? Because it comes to stop all these traders out that are predicting that there would be a liquidity sweep, which means that you would get stopped out right here, right? However, we see there's a sweep here, right? Price comes up, stops people out, and then heads lower. Now, where does price head next? Well, price would head right here, right? It would come down to external sell side liquidity, right? So all these people selling here, right? Placing their orders, waiting for them to get executed, right? Gets entered in right here. But then they also get stopped out at the same time because it's a liquidity sweep to create money for smart money concepts, which will then be able to make money right here in this little uptrend, right? Now, this happens on all time frames, right? So let's say we take a look at a 15-minute chart, right? This is a perfect prime example of how to tell when there's a liquidity sweep or when it becomes a market structure shift or break of structure, right? So we have our ranges here, right? And we have this here, right? It's a little higher. It's like around here. So we have our range right here, okay? This is where we're looking to buy and sell. Remember, this is on the 15-minute, and it happens on all time frames. So this would be your external draws, right? And inside here would be all your internal draws. Now we see here that price creates buy-side liquidity and sell-side liquidity. We see price heads and seeks what's sell-side liquidity, right? It comes down, sweeps low. It could close below. It could wick all the way down and come back and close. As long as it's in the proximity of this wick, it's called a liquidity sweep. So it sweeps and then it head higher, right? But this is a prime example of what would not be a liquidity sweep. See that we have the line right here, and if we were to really zoom in, you can see that this never quite touches it or goes a little past it, right? So this would be an invalid liquidity sweep, right? If they were to be like this, right, completely equal, this would also not be a liquidity sweep. We would call these equal highs or equal lows, which gives us more confluences that there are more sells and sell stops here, right? Which is why, in this case, this buy side liquidity became what's known as a break of structure. You might ask why. Remember, break of structure is when price breaks, let's say, like the structure that we're in, downtrend, right? We're in a downtrend. But then, break structure with a huge momentum, right? We need momentum. We need a somewhat big gap, right? We need a big gap. So this buy side liquidity becomes a break of structure, right? See how we're in a downtrend? And if we zoom out, it soon becomes an uptrend. So whenever a sell side or buy side liquidity has huge displacement and price doesn't, sweep and come down, it normally becomes a break structure or market structure shift, right? Now let's take a look at, let's say, another example of a sweep that becomes a breaker structure, right? So let's say we're looking at it right here, right? We have our externals here, right? And if we were to look, this would be our buy side. This would be sell side. And if we take a look, we see that price comes down and sweeps, right? However, we see that price is still respecting bearish confluences, and we don't really get a huge displacement up. Instead, it continues lower. This means that this liquidity sweep becomes a breaker structure, right? So when we go from uptrend, a downtrend, and then we come up to an uptrend after this, also a liquidity sweep becomes a breaker structure, right? This buy side liquidity is passed through with a huge momentum displacement and becomes a breaker structure, which is why we go from a downtrend and again to an uptrend, right? So they're pretty easy to find, right? So we can see if we just eyeball it, we can see here's a liquidity sweep, right, at this low. Price came down, sweep traders out, and headed higher. We can also see example that's right here, right? Price came down, sweep took out these people and head higher to draw on. The draw was on this buy side liquidity, which was also swept and headed lower, right? We can see the same thing happen on all of the highs, right? Sweep lower, right? Let's take a look. This would not be an example of a buy side. A sell side sweep, right? Because these are relatively equal lows, right? They're about the same. We don't see any sweep, right? Which means that the confluence of price coming back is very high, which is why in this following week, we plan on seeing price coming down to this area. You can also see that this is also not a liquidity sweep because it never came down, right? So we have another liquidity sweep here, and we also have, let's see, a liquidity sweep here, right? You can see these on all time frames, right? I can even go on the 4-hour, right? If we look on the 4-hour, we can see that price right here. Let's see, price right here. If we zoom, sweeps and then it heads higher, right? You can also see here. Let's take a look at a better example. We can see here in this range here, right? You get a little sweep, right? As long as there's no huge displacement, it's a liquidity sweep. If we see huge displacement, right, then it would be a breaker structure. For example, like this, right? We get a little sweep, it comes up, but then it drops immediately, making a big displacement and gap, right? Which soon this is reacted off later on in price, right? And then it reacts off. Now, how do we use this to enter, let's say, a trade, right? Well, now that we know a breaker structure, fair value gap, and a liquidity sweep, we can put all those together to form a somewhat probable trade, right? So let's take a look. Let's say we're looking to take a trade and we see that price got swept here inside, right? Price got swept at this buy side high, right? And we see stops traders out and creates fair value gap when it comes down right here, right? Here we see fair value gap, right? From here to here. And usually what happens after, let's say, buy side liquidity swept, what is the draw on where price wants to go? The external low, right? This high and this low. So if we were to see, we could see that price liquidity sweeps, huge displacement down, and we would say, oh, we can enter off of this fair value gap like this, right? And you would target the lows, right? Perfect example. Now let's say you want to do the same thing, but for sell side liquidity, right? You want to look for buys, right? Example right here. This would be a good example. We have sell side liquidity resting, gets swept, right? So we're like, okay, we just need to see price come back up, knowing that the draw would then be higher at these external liquidity, right? So we come down, we sweep this, and guess what? We get a fair value yet, right? And then we also get a nice break of structure, right? Because it closed up. So we would enter our trade in a buy, right? Because we know price is higher. Stop right below the low, and we would target the external draw on liquidity, right? And that would be a perfect trade, right? So what I want you guys to do is put your confluence all together. Find 3 examples of a liquidity sweep and what's not a liquidity sweep, buy side, sell side, external, internal, and know that see how price, whenever it reaches sell side or buy side, it tends to reach for the other side, right? Right? This is a prime example. Reaches buy side, comes to sell side, right? And I want you guys to enter a trade example like I did, where you enter off fair value gap. You can put the enter at the middle of the fair value gap or when price exactly taps into it, and have your stop on the highs and see how price reacts to it. All right. So this is liquidity sweeps. If you have any questions, just DM me in the Discord and I'll answer them or send screenshots.